It's no surprise that the Federal Reserve has been attempting to fight inflation. They've been doing this by slowly reducing the size of their balance sheet and raising interest rates. But what you may be surprised to hear is that one of the ways the Federal Reserve has been fighting inflation is by printing money. And not just a small amount of money either. Right now, it's somewhere around $16 to $17 billion per month, which adds up to a whopping $200 billion per year. Now, if you have any bit of logic in you, you're probably thinking, how in the world could they be printing money in order to fight inflation? It seems like those two are at direct odds with each other. But that's not even the most surprising part of this story. The most interesting part is that it also has something to do with the money that the Federal Reserve used to pay directly to the US government, which that amount has now fallen off a cliff and turned seriously negative. So what in the world is up with this negative remittance the Fed owes to the Treasury? And how in the world does that relate to what the Federal Reserve is doing right now to try and fight inflation by printing money? Well, this story starts in the place that most economic stories start these days, and that is the Federal Reserve's balance sheet. The Federal Reserve's balance sheet at one point was up near $9 trillion, and today is worth just under $8 trillion. The easiest way to understand the Federal Reserve's balance sheet is just to look at it like a brokerage account. So you've got a brokerage account, you might have cash in there, you might have stocks in there, maybe some mutual funds. The Fed's brokerage account, this balance sheet, holds mortgage-backed securities and US Treasuries. Now, both of these asset types are debt, and one thing about debt is that it pays interest. And so the Fed has $8 trillion worth of debt that other institutions owe to the Fed, and it collects the interest on those assets. So this $8 trillion balance sheet that the Federal Reserve has produces income for the Fed. Now, you may be aware of this as well, but the Federal Reserve also has expenses. While the entire job of the Federal Reserve could be done by the free market, the Fed doesn't need to exist. The fact is, they do. And those expenses have become extremely bloated recently for a number of reasons. First of all, the Federal Reserve is the largest employer of PhD economists in the world, with over 400 PhD economists employed there. It's almost like academia and treating economics as if it's a physical science is somewhat flawed, because clearly it's not working out too well. And just so you know how insane it is that they employ 400 PhD economists, we have to take a look at the second runner-up for who employs the second most PhD economists, and that is actually Amazon. And as of 2019, they had hired over 150 PhD economists. Given the incentive structure, in other words, profits and losses, and the fact that over 75% of Americans shop on Amazon, giving them the largest transactional data set in existence, it makes sense that they would want to employ economists to understand financial trends. Amazon's economists look at product descriptions to identify quality. They index their products based on consumer demand and pricing history. It stands to reason that they are able to measure and predict inflation better than any government entity, because they have the incentive to do so and vastly more resources and data. And yet even Amazon doesn't need or have as many PhD economists as the Fed. Like I said, bloated. But that is far from its largest expense. That is just one thing, the headcount that it has to support. The Federal Reserve also pays dividends to its member banks. But the biggest expense of all is the interest that the Federal Reserve pays on two things. Number one, bank reserves, and number two, the balance in the reverse repo facility. As of 2008, the Federal Reserve started paying interest on reserves that banks held with the Federal Reserve. As of September, the level of reserves held at the Fed by banks is about $3.2 trillion. Given the fact that the federal funds target range is in between 5.25% and 5.5%, the $3.2 trillion in reserves is costing the Federal Reserve quite a bit of cash. On top of that, we also have the $1 trillion that is still left in the reverse repo facility. Any dollars in the reverse repo facility, the Federal Reserve pays 5.3% to those financial institutions. So let's just round down to 5% for easy math between what the Federal Reserve pays on the bank reserves and into the reverse repo facility funds. Add up those two amounts at 3.3 trillion plus 1 trillion. Let's just round down for ease of numbers to $4 trillion. That means the Federal Reserve right now is paying between $16 to $17 billion per month. Annualized, that's $200 billion per year. Now you're probably thinking right now, yeah, $17 billion a month. That's a lot of money to be paying out just in interest to bank reserves and the reverse repo facility, but they've got an $8 trillion balance sheet. They should be able to handle that just fine, right? Well, prior to September of 2023, they could handle that just fine. And in fact, the amount of money they were making from their balance sheet was well in excess of the dollars that they had to pay out. But before we get to what changed in September of 2022, it's important to know what the Federal Reserve was doing with those excess profits. Because the Federal Reserve is not a private entity, despite what you've been told. It is a quasi-private, quasi-public entity. It has elements of both a private entity and a public governmental entity. That is true with both its leadership structure and with its financial structure. The people who are running the Fed, some of them are put into power through the banks. And also some of them are put into power through the US president. When you look at its financial structure, it does have some elements of being a private institution. Like I talked about earlier, it pays out dividends to its member banks. But after accounting for all of its expenses, once all those expenses are covered, anything that has left over, it sends right back to the United States government. So for years, every single week, when the Federal Reserve had any money left over, they took those dollars and sent them right back to the United States government. Every week, this money ran in the neighborhood of $1 to $2 billion. On an annualized basis, that meant the United States government was seeing $100 billion or so from the Federal Reserve every year. If we look at income by source for the federal government, take a look at the orange category called miscellaneous income. 0.14 trillion. In other words, about 140 billion for 2022. 2021, that miscellaneous income number was about 150 billion. Prior year, 140 billion. Prior year, 100 billion. Back to 2018, 130 billion. That miscellaneous income category counts the money that they were getting from the Federal Reserve from the Fed's excess profits. But in September of 2022, this all changed. And in fact, it changed rapidly. As you can see, these so-called remittances that the Fed owed to the Treasury went steeply negative and are now sitting at an insanely steep negative $110 billion. And if we go back to US government revenue by source, you can see that for the year of 2023, that miscellaneous income fell off of a cliff, now at 0.04 trillion. In other words, $40 billion, basically missing the entire chunk that they used to count on from the Fed. So for years prior to September of 2022, the Federal Reserve's balance sheet produced enough income to cover all of the Fed's expenses and then some. All the leftover money they sent right back to the government. But in September of 2022, that changed and they no longer had enough money coming in to cover all their expenses. So the question is, where did that money come from? Well, contrary to literally every other institution in existence, a central bank doesn't have to worry about profitability. They have the legal monopoly on the creation of money, which means any dollar they need, they literally just print into existence. And of course, they're not printing the physical dollars. If they owe $1 in interest to a bank, that bank has an account with the Fed and the Fed just says, okay, you have $1 extra now. That's it. Through the computer, they just make that dollar come into existence, crediting it to the proper account. But what about this steeply negative number as the Federal Reserve stopped paying the US Treasury? What is happening there? This is a cumulative tally of all of the dollars the Federal Reserve has printed to cover its losses. As of October of 2023, this number stands at $110 billion. So this is not money going from the government to the Federal Reserve. Taxpayers are not directly on the hook for this. The Federal Reserve is just printing those dollars. But because they're printing those dollars that they are paying out from operating at a loss, they're keeping that running tally so that if they ever become profitable profitable again, they get to pay themselves back for every dollar that they printed. And don't worry, I am going to explain how they're using this money printing to try and fight inflation. But we have a couple more puzzle pieces we have to fit together first. So hypothetically, let's say the Federal Reserve changed monetary policy tomorrow with interest rates the size of its balance sheet, and suddenly it became profitable again. So far, it has printed $110 billion to cover its losses. Let's also say that over the next year, they accumulate profits of exactly $110 billion. In paying themselves back for those losses that they printed, they're actually removing those dollars from circulation. They would be destroying them because in order to pay them out, they created them. When those dollars get paid back to them, they would destroy them. They would just cease to exist. So in the event of future profitability for the Fed, they will not immediately start taking those profits and paying them back to the United States government. They have to destroy at this current time $110 billion first before they start paying the government again. Okay, that makes sense, but why did this chart fall so quickly off the cliff when it was so steady for so long? Why is it so steeply negative now? This is actually due to a really preposterous methodology change in my mind, and I don't know why they would do this in one single chart, but this chart is actually two built into one. Prior to September of 2022, this chart shows the weekly amount that the Federal Reserve sends to the government. But after September of 2022, all this chart is showing is the total cumulative amount that the Federal Reserve has printed. Lynn Alden does a great job of pulling this chart apart into two separate charts, which is how it should be. The blue chart in the background shows the weekly amount both prior and after September of 2022. And you can see those weekly amounts that are negative are proportional in size to the weekly amounts while they were profitable. The orange line in the front that you can see shows from beginning to now the cumulative amount. And while it has dropped down recently, it is really not that large compared to the history of how much money in total the Fed has sent to the government. And just in case you doubt this, take a look at the release of the recent data set from the Federal Reserve. You can see the notes on every single one of these releases, but this one is the most recent one from October 18th, 2023. That negative amounts represent the cumulative deferred asset position, which is incurred during a period when earnings are not sufficient to provide for the cost of operations. Essentially, anytime that number dips negative on the chart, it starts adding it up on itself cumulatively every single week instead of only showing each week's amount. Okay, and now for the most curious part of this whole entire conversation. How is it that the Federal Reserve is simultaneously saying they're trying to fight inflation while printing $17 billion per month? Is this just stealth QE, or is there something even more complex going on? As a reminder, there's $1 trillion in the reverse repo facility and over $3 trillion in bank reserves. All of these dollars are earning over 5% annually right now. Well, here's the dark truth about all of this money that the Federal Reserve is paying right now to financial institutions to hold cash with the Fed. This money is not out working in the economy. Take, for example, you and I. Let's say we get any type of debt for any purpose. I tell a bank, give me your money at 5%, 10%, 20%, whether it's a mortgage or a credit card or an auto loan. I'm gonna use that money to do something. I'm either gonna use it for a business loan, for hiring, I'm gonna buy an asset like a rental property, or maybe I just buy something absolutely stupid like any consumer goods that are overpriced, and I just go and blow it all at the mall, taking out a new credit card and maxing it out at the mall, just going on a shopping spree. No matter what I use that debt for, there are varying levels of how that debt goes to work in the economy. Because even if I do the worst thing possible with it and I just spend it on luxury consumable goods, that money is still then going to somebody who produced something. It's being used to pay employees that then get to use it to do something else with. So that debt is being used for somewhat productive purposes. And obviously, if I use it for something else, like a business loan or buying an asset, then that's even more beyond that. But every dollar held at the Federal Reserve through bank reserves or through the reverse repo facility is getting paid interest to sit there and do nothing and be completely unproductive. And that's the point. The Fed does not want this money in circulation. It does not want this money being made available to individuals and businesses. That is the exact reason why it's paying such a high interest rate. That is what it does by raising interest rates. It incentivizes money to come to the Fed and sit there unproductively. And the only way it can incentivize that money to do so is to reward it for doing that. This makes it harder and in some cases impossible for private individuals or corporations to get the capital they need to be productive economically. And even though the Federal Reserve is printing hundreds of billions of dollars in order to pay a reward to banks for not allowing their money to be put to work with individuals in the private economy, it still has the net effect of shrinking the money supply. To the extent that the money supply is shrinking at a pace that it hasn't shrunk by since the Great Depression, 1930 to be exact. By rewarding financial institutions to keep this money out of circulation, it becomes so scarce for everybody else, driving down economic activity to fight the very inflation that they caused in the first place by printing money at a greater extent than it had ever been printed in US history. It sure is a good thing that they hire hundreds of PhD economists so that they can work out how to help the everyday American. Monetary policy is sure doing wonders. And finally, I would like to make you guys aware of number one, a big promotion, a discount available for Heresy Financial University, and some changes that are coming up that are very important. So number one, in case you're not aware, Heresy Financial University, it's a membership program that gives you unlimited access to every financial course that I've put together. Portfolio allocation, hedging, advanced options strategies, fundamental analysis to be able to identify the best companies in the world and the best prices to be able to buy them at, getting out of debt, mastering your retirement account system, and much, much more. But starting November 1st, which is this coming Wednesday, I'm also starting a brand new group live coaching call available for members only. In addition to that, starting in 2024, so just a couple months away, I'm adding a few new benefits, which means I'm actually going to be raising the price. The good news is that the price is locked in for members. So you become a member now, your price is locked in. As long as you're a member, it will never change. The price will be going up though for new members starting 2024. And then finally, the discount that I told you about. Right now only until midnight on Halloween, I'm running a discount code SPOOKY, SPOOKY, that gives you your first month for just $1. I've run this promotion twice and they both sold out. The first time it sold out in 90 minutes. So this time, if you sign up, become a member of Heresy Financial University between now and midnight on Halloween, October 31st, you'll get your first month for $1 and you'll lock in that member pricing of $99 even through next year once the prices go up. And on top of that, you're also getting in right ahead so that you can join that first group live coaching call on November 1st. You're gonna be given the tools that you need to earn tens of thousands, and in some cases, even hundreds of thousands of dollars more than you're making right now with the stuff that you're gonna learn as a member of Heresy Financial University. So can't wait to see you there. Link is below. Thanks so much for watching. Have a great day.